Gold just posted its worst week since 1983. Not its worst week this year, its worst week in 43 years. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Gold closed Friday at $4,704, down 9 to 11% in 5 sessions. That is not a pullback, that is a structural repricing. And the number behind that number is what we are building today. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now back to the data. Lead story today, the Federal Reserve. The FOMC held the federal funds rate at 3.50 to 3.75% on March 19, 2026. That was expected. What was not expected was the dot plot. 7 of 19 FOMC participants now signal 0 rate cuts in all of 2026. That is one more than December's update. The median projection for year-end 2026 moved to 3.4%, up from 2.9% in December. Fed Chair Jerome Powell said directly, the forecast is that progress on inflation will happen, but not as much as hoped. One projected cut for 2026. That single number is doing structural damage to gold's near-term pricing. Gold is a non-yielding asset. When the rate outlook shifts hawkish, the opportunity cost of holding gold rises mechanically. The timing is what deserves scrutiny, not the hold itself, the timing. The Fed holds. Gold drops 6.6% in one session. Think about what that sequence actually means. The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. The last time gold posted a weekly loss of this magnitude, the S&P 500 was trading below 200. That was 1983. The data is already telling you something. Let's build it out. Now let's build the full picture because the Fed hold does not exist in a vacuum. The US dollar index, the DXY, sits at 99.3 to 99.42, up nearly 2% since the Iran war began 3 weeks ago. The 10-year Treasury yield hit 4.37% on Friday. That is its highest level since July 2025, according to Trading Economics. The 2-year Treasury yield rose nearly 10 basis points to 3.93%. These are not small moves. These are the exact inputs that mechanically compress the price of a non-yielding dollar-denominated asset. Meanwhile, the U.S. economy lost 92,000 jobs in February. Unemployment rose to 4.4%. And gasoline hit a national average of $3,142 per gallon, up 92 cents in a single month, according to AAA data. DataTrack Research named this directly a stagflationary shock, weakening growth, rising inflation, simultaneously. The rate of repricing is not slowing, it is compounding. The data is doing the talking. The ones who said gold's 2025 rally was built on real structural demand. They are watching a paper market correction against fundamentals that have not changed. And here is what makes that picture even harder to ignore. Shanghai. The physical gold premium over COMEX remains structurally intact. Trading Economics confirms persistent physical premiums in the East are running ahead of Western paper pricing. Central bank buying programs drove gold's 64% run in 2025. Published reserve data shows zero reversal signal from those programs. At the same time, paper markets on COMEX are pricing aggressive liquidation. That is not a contradiction. That is the setup. Physical demand holding, paper selling accelerating. Those two forces cannot both be right indefinitely. And before anyone takes that as a green light to buy, setups can take a long time to resolve. What this tells you is the structural picture. The timing is a completely separate question. Anyone who claims to know the timing is selling something. Now the Iran war, because this is no longer a backdrop. It is the primary variable. Here is the number most people are not talking about. 92 cents. That is how much the national gasoline average has risen in a single month according to AAA data cross-referenced with DataTrack Research. From the moment U.S. and Israeli forces struck Iran, energy prices repriced immediately. Brent crude sits above $107. 3 weeks in. No ceasefire signal. No de-escalation pathway publicly confirmed. Markets are still pricing this as a contained regional conflict. Look at $107 Brent crude and tell me what probability you put on that containment assumption. Morgan Stanley's Andrew Shcherovsky said it clearly. What the Iran war does for the Fed is delay, not deny, rate cuts. But EY Parthenon chief economist Gregory Dacko said something harder. It is entirely plausible the Fed delivers 0 cuts in 2026. Some analysts now openly discuss rate hikes if inflation becomes entrenched. When markets start pricing the reality of what a prolonged Iran conflict actually means, gold's opportunity cost framework reprices. The dollar reprices. Every rate-sensitive asset reprices. That is the historical pattern. Every time a major Middle Eastern conflict has intersected with a Fed tightening cycle, it has not been different yet. Gold Western spot at 4,704. Day range. Friday, 4,634 to 4,735. Prior close, $4,650.77. Shanghai physical premium over COMEX. Confirmed structurally intact per trading economics data. Short-term picture is binary. If the Iran conflict shows any de-escalation signal, oil corrects, inflation expectations fall, rate cut odds recover from their current 16% June probability, and gold reprices toward $5,200 rapidly. If the conflict extends and inflation becomes entrenched, the Fed holds or hikes, DXY recovers above 103, real yields push toward 2.5%, and $4,000 is a credible downside target. That is the only short-term read that matters right now. As for trading it, I cannot see a clean picture on the lower time frames right now. I cannot tell you what gold does Monday morning. Nobody can. Today is Saturday, March 21st, 2026. Markets are closed. The next price discovery event is Monday's open. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. 1. The DXY at 99.42 is up 2% since Iran began, and technically targeting 103 to 105 resistance. 2. 7 of 19 FOMC members now project 0 cuts in 2026 per the official dot plot released March 19th. 3. The 10-year Treasury yield at 4.37% is the highest since July 2025, raising gold's opportunity cost mechanically. The bull case is equally real. 1. Shanghai physical premiums over COMEX remain structurally intact per trading economics, confirming real Eastern demand has not reversed. 2. Central bank buying programs that drove gold's 64% rally in 2025 show 0 reversal in published reserve data. 3. Morgan Stanley's Sucharovsky confirms Iran delays, does not deny, rate cuts, and major bank year-end targets of $5,000 to $6,300 remain published and unreduced. Size correctly. Know what you are in before you are in it. The physical market already knows where this is heading. The paper market is still arguing. That argument does not last forever. Everything shown today points to one thing. The structural demand floor is intact. The paper market correction is real, and those two facts cannot both remain true indefinitely. Do not take my word for it. Verify every number I gave you today. Check the data yourself. Federal Reserve.plot at federalreserve.gov, US dollar index, and 10-year yield at tradingeconomics.com. Gold and silver spot pricing at investing.com. Logic over hype, always. If this analysis added value, like this video right now, subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. OG John AG 1.0, out.